Welcome to XRP Pro Ledger. And I'm going to need you to stop whatever you are doing right now because the information that just dropped in the last 24 hours around XRP represents a convergence of institutional, legislative, and technical developments that this asset has never experienced simultaneously at this speed. And if you are not fully locked in for the next several minutes, you are going to miss the context that separates the people who understand what is happening from the people who are going to be reading about it in hindsight, wondering why they didn't act when the signals were this clear. Goldman Sachs has just filed a $153.8 million position in XRP ETFs distributed across 4 separate funds. And that number is not the headline. The headline is the timing. Because the Clarity Act, the most significant piece of digital asset legislation in American history, is not weeks away, it is not months away. It is being presented to the Senate Banking Committee this week. And XRP is sitting at 142 to 143, compressing inside a silver wedge pattern with $3 billion in daily volume, with spot XRP ETFs crossing $1 billion in total AUM, right at the exact moment that the legislative and institutional pieces are landing simultaneously. The banks just found out the timeline accelerated. That is why they are panicking. That is why Goldman moved first. And that is what this video is going to prove to you in detail. Let us establish the Goldman Sachs position first, because understanding the mechanics and the implications of this specific filing is the foundation on which everything else in today's analysis rests. A $153.8 million position in XRP ETFs distributed across 4 funds is not a single investment decision made by one portfolio manager in one department. Distributing that exposure across 4 separate funds means that multiple investment committees, multiple compliance teams, multiple risk assessment departments, and multiple client-facing divisions within Goldman Sachs all independently cleared XRP as an appropriate asset for inclusion in their respective mandates. Each of those 4 funds has its own investment policy statement, its own regulatory requirements, its own client base, and its own risk parameters. XRP clearing all of them simultaneously means that Goldman's institutional evaluation of XRP was not a marginal pass. It was a comprehensive approval across the full breadth of the firm's investment infrastructure. That is a categorically different signal than a single fund making a speculative allocation, and the market has not yet fully priced in what it means. The distribution of Goldman's position across 4 separate funds also tells you something critical about the strategic intent behind the allocation that a single fund position would not reveal. When an institution like Goldman Sachs wants to make a speculative bet, they concentrate it in one vehicle, a single fund that can absorb the upside and the risk without contaminating the firm's broader portfolio. When Goldman wants to make a structural allocation, a positioning decision that reflects a long-term conviction about an asset's role in the financial system, they distribute it across multiple funds so that the exposure is embedded in the firm's institutional DNA rather than isolated in a single product. The 4-fund distribution of the $153.8 million XRP position is Goldman telling you, through the structure of the trade, rather than through any public statement, that this is a structural allocation built on a long-term thesis. And that long-term thesis has a legislative cornerstone that is about to be formally presented to the most powerful banking committee in the United States Senate this week. Now, I want to address the banking lobbying scandal directly because it is not a sideshow to the main story. It is actually the most revealing indicator of how significant the Clarity Act's accelerated timeline is, and how much the traditional banking establishment understands what is at stake. The reports coming out of Washington describe a coordinated lobbying campaign in which major traditional banks are sending pre-written scripts to their own employees and instructing them to call their senators to oppose the Clarity Act, specifically targeting the stablecoin yield provisions that would allow regulated stablecoins to pay interest to holders. The fact that these banks are mobilizing their own workforce as a lobbying army against this legislation tells you 2 things with absolute certainty. First, They believe the Clarity Act has a genuine chance of passing because you do not deploy this level of internal political mobilization against legislation you expect to fail on its own. Second, the stablecoin yield provision specifically threatens the foundational business model that makes retail banking profitable, the spread between what banks pay on deposits and what they earn on loans. Let us unpack the deposit flight concern that is driving the bank lobbying panic, because this is the economic mechanism that connects the Clarity Act directly to XRP's value proposition in a way that most analysts are not explaining clearly enough. Traditional banks make money through a model called net interest margin. They accept deposits from customers, pay those customers a low interest rate, currently around 0.5% at most major retail banks, and then deploy that deposit capital into loans and securities that earn significantly higher returns. The spread between what they pay depositors and what they earn on deployed capital is the fundamental source of bank profitability. The Clarity Act's stablecoin yield provisions would create a competing product: regulated stablecoins that pay holders a market rate yield that directly threatens the bank's ability to retain low-cost deposit capital. If customers can earn a meaningful yield on regulated stablecoins while still having the stability and accessibility of dollar-denominated assets, the rational economic decision for millions of depositors is to move their money out of traditional bank accounts and into yield-bearing stablecoins. That is deposit flight. And for large retail banks, deposit flight is an existential threat. The connection between the deposit flight threat and the aggressive accumulation of XRP that Goldman Sachs and other sophisticated institutions are executing right now is not coincidental. It is strategic, and it is sequenced in a way that becomes obvious once you understand the legislative timeline. Goldman Sachs building a $153.8 million XRP ETF position before the Clarity Act is formally presented to the Senate Banking Committee is the institutional equivalent of positioning ahead of a known catalyst. Goldman's research division tracks legislative developments with the same rigor that it tracks earnings releases and macroeconomic data. They knew the Clarity Act timeline was accelerating before it became public knowledge, and the filing of a $153.8 million position across 4 funds right before this week's Senate presentation is Goldman executing on that advanced knowledge in the most direct way available to them. The banks that are now scrambling to mobilize employees for a lobbying campaign are responding to the same information that Goldman was acting on weeks ago. The difference is that Goldman was buying while the panicking banks were still in denial about how fast the timeline was moving. The Silver Wedge technical pattern that XRP is forming right now at the $1.42 to $1.43 consolidation level needs to be understood in the context of everything else happening fundamentally, because when a powerful technical setup and a powerful fundamental catalyst are aligned in the same direction at the same time, the resulting price move tends to be significantly larger and more sustained than either the technical or the fundamental analysis would suggest in isolation. A silver wedge is a compression pattern where the price range is getting progressively tighter. Higher lows are meeting lower highs within a converging structure that stores kinetic energy like a compressed spring. The longer the wedge compresses and the tighter it gets before resolution, the more explosive the breakout tends to be, because the compression represents an extended period of supply and demand equilibrium that releases all of its stored energy in a single directional move when the balance finally tips. XRP has been compressing inside this wedge with $3 billion in daily volume. That volume is the engine of institutional accumulation happening inside the compression. And when the Clarity Act news hits the Senate Banking Committee this week, that engine is going to fire. The $1 billion in spot XRP ETF total assets under management milestone is a number that deserves to be examined for what it represents structurally. rather than just celebrated as a round number achievement, because the mechanics of how ETF AUM grows and what drives it tell you a great deal about the nature and durability of the demand that is building beneath XRP's current price. ETF AUM does not grow through individual investors making one-time purchases. It grows through systematic, recurring capital deployment by registered investment advisors, institutional asset allocators, and brokerage platforms that have added the ETF to their approved product lists. Every dollar of AUM in a spot XRP ETF represents a dollar that has gone through a compliance review, an investment committee approval, and a client suitability assessment before landing in the fund. That capital is patient, it is long-term oriented, and it grows through the same systematic flows every month, regardless of short-term price volatility. The 1 billion AUM milestone means that the infrastructure for systematic, recurring institutional demand for XRP is fully operational and growing, and it was established before the Clarity Act has even been formally presented to the Senate Banking Committee. Let us talk about what the Clarity Act actually does at a technical legislative level, because a lot of the commentary around this bill treats it as a vague positive development for crypto without explaining the specific mechanisms through which it changes the regulatory landscape for assets like XRP in concrete and immediately actionable ways. The Clarity Act establishes a comprehensive legal framework that defines when a digital asset is a commodity versus a security, creates clear registration and disclosure requirements for digital asset exchanges and intermediaries, and critically, provides a regulatory safe harbor for decentralized blockchain networks that meet specific criteria for genuine decentralization. For XRP specifically, the Clarity Act's passage would formally resolve the lingering regulatory ambiguity that has prevented certain categories of institutional investors from taking on XRP exposure. Specifically, the pension funds, endowments, and insurance company general accounts that operate under investment guidelines requiring clarity about an asset's regulatory classification before they can allocate to it. Those institutions have not been absent from the XRP market because they are skeptical. They have been absent because their compliance frameworks require a legal clarity that has not previously existed. The Senate Banking Committee presentation this week is not the end of the legislative process. It is the beginning of the final act. And understanding the legislative sequence that follows a committee presentation helps you calibrate the realistic timeline for when the Clarity Act's full impact on institutional capital flows will be felt. When major legislation is formally presented to a Senate committee, it triggers a specific procedural sequence. Committee markup sessions where amendments are proposed and voted on, a committee vote to advance the bill, floor scheduling by the Senate Majority Leader, potential cloture votes to limit debate, and finally a full Senate floor vote. That process can take anywhere from a few weeks to several months, depending on the level of bipartisan support and the political calendar. The critical insight for XRP holders is that institutional capital does not wait for the final floor vote to begin positioning. It positions at the moment of credible committee advancement, which is happening this week. Goldman Sachs did not wait for the floor vote. They positioned before the committee presentation. The next wave of institutional allocators will position at the committee vote. The wave after that will position at the floor vote. Each wave pushes the price higher. The competitive pressure dynamics between traditional banks and crypto-native financial infrastructure are worth examining in detail, because they explain why the bank lobbying campaign against the Clarity Act is ultimately a losing battle, even if it manages to delay the legislation in the short term. Banks are not lobbying against the Clarity Act because they believe it is bad policy. They are lobbying against it because it is existentially threatening to their current business model. But here is the strategic problem with their position. The longer the Clarity Act is delayed, the more institutional infrastructure is built around regulated crypto assets that operate outside of the traditional banking deposit model. And the more that infrastructure scales, the harder it becomes for traditional banks to compete with it when clarity eventually arrives. Goldman Sachs understands this dynamic, which is why they are positioning in XRP ETFs rather than lobbying against the legislation. The banks that are currently spending resources fighting the Clarity Act are the same banks that will be desperately trying to acquire crypto infrastructure capabilities in 2 years, when the legislation passes anyway and their deposit base has been eroded by regulated stablecoin alternatives. Goldman is on the right side of this trade, and the $153.8 million position is the proof. The broader institutional ecosystem developing around XRP beyond the Goldman Sachs filing provides the demand architecture that explains why the Silver Wedge compression at $1.42 to $1.43 is being supported by $3 billion in daily volume, rather than quietly decaying into a lower energy consolidation. Ripple's conditional approval for a national trust bank charter places it under the same regulatory framework as the largest financial institutions in America, making it a legitimate institutional counterparty rather than a technology vendor. WXRP live on Solana through Hex Trust and Layer 0 has opened XRP's exposure to a multi-billion-dollar DeFi ecosystem. Kyobo Life Insurance is tokenizing South Korean government bonds on XRPL, establishing the precedent for sovereign debt settlement on XRP infrastructure in one of Asia's most rigorous regulatory environments. PNC Bank is fully operational on RippleNet. The DTCC's $90 trillion tokenization initiative is moving to production on infrastructure that aligns with XRPL's architecture. WhatsApp integration has given 2 billion users direct access to XRP through an app already on their phones. Each of these developments is a separate source of organic demand, and they are all building simultaneously beneath a price level that reflects none of their combined significance. The geopolitical and macroeconomic backdrop within which all of these XRP-specific developments are occurring adds another layer of significance that institutional allocators are clearly factoring into their positioning decisions. The U.S. government's inclusion of XRP in its strategic crypto reserve signals to every nation-state evaluating its own digital asset policy that XRP has achieved sovereign-level recognition in the world's most influential financial jurisdiction. The incoming Federal Reserve Chairman's disclosed position of over $100 million in assets with significant crypto exposure signals that monetary policy is about to be conducted by someone with personal alignment with the digital asset ecosystem for the first time in the Fed's history. The Clarity Act's accelerated timeline signals that the legislative branch is moving faster than the market expected to provide comprehensive regulatory clarity. These three sovereign-level signals, executive reserve inclusion, central bank leadership alignment, and legislative acceleration, are all pointing in the same direction at the same time. And they are all pointing directly at XRP as the asset that has spent the most time building the institutional relationships and legal infrastructure required to benefit from exactly this convergence. The retail dimension of the XRP story that is developing in parallel with the institutional developments deserves its own dedicated analysis because the demand dynamic it creates is fundamentally different from institutional demand. And the two types of demand compound each other in ways that create non-linear price effects. WhatsApp giving 2 billion users direct access to XRP purchase is not just a convenience upgrade, it is the activation of the largest potential retail demand base in the history of cryptocurrency. The regions where WhatsApp dominates as a communication platform, Latin America, Southeast Asia, South Asia, the Middle East, Sub-Saharan Africa, are precisely the regions where cross-border remittance demand is highest, where traditional banking access is most limited, and where the cost of international money transfer is most punishing for ordinary families. When retail demand from a 2 billion user base begins flowing into XRP through WhatsApp at the same moment that institutional demand is being driven by Goldman Sachs ETF filings, Clarity Act positioning, and bank charter approvals. You have the ingredients for a demand shock that the current $1.42 to $1.43 consolidation price cannot contain for long. Let us address the timeline convergence with total clarity because the precision of the timing between Goldman's $153.8 million filing, the Clarity Act's accelerated Senate Banking Committee presentation this week, and the Silver Wedge's technical compression at $1.42 is not something that analytical honesty allows us to dismiss as coincidence. Goldman Sachs filed a $153.8 million XRP ETF position, distributed across 4 funds, right before the Clarity Act is formally presented to the Senate Banking Committee this week. The banks that stand to lose the most from the Clarity Act stablecoin yield provisions simultaneously launched an emergency lobbying campaign using pre-written employee scripts to call senators. XRP is compressing inside a silver wedge with $3 billion in daily volume and $1 billion in ETF AUM, providing structural support at the exact level where 60% of the circulating supply has its cost basis. Every single element of this convergence is pointing toward the same event, a legislative catalyst this week that Goldman anticipated, that the banks fear, and that the Silver Wedge is technically primed to amplify into the most significant price move XRP has seen since its last major breakout. The coil is set. The catalyst is arriving. The institutions are positioned. The complete picture you now have access to is one that very few people outside of institutional research teams have assembled in one place, with the accuracy and the timing precision that this moment requires. Goldman Sachs positioned $153.8 million across 4 XRP ETF funds before the Clarity Act news broke this week. They knew the timeline had accelerated. Traditional banks are running emergency lobbying campaigns because they found out the timeline accelerated, and they are terrified of what stablecoin yield provisions will do to their deposit base. The Senate Banking Committee is receiving the Clarity Act this week, not in August, not in 10 to 11 weeks, this week. XRP is sitting at $1.42 inside a silver wedge with $3 billion in daily volume and $1 billion in ETF AUM, providing the institutional demand floor. Every sovereign-level signal, strategic reserve inclusion, Fed chairman alignment, legislative acceleration is pointing toward XRP. Every institutional signal, Goldman's 4-fund position, ETF AUM milestone, bank charter approval, PNC and Bank of America deployment, Kyobo Life bond tokenization is pointing toward XRP. And every technical signal, silver wedge compression, volume structure, support holding at $1.40 is pointing toward an imminent breakout. The banks panicked because they ran out of time. Goldman moved because they saw it coming. If this analysis changed how you're thinking about XRP, hit like and subscribe. I drop deep dive breakdowns like this twice a day to keep you ahead of the market.